Good morning, everyone. We're pleased today on a very fine Friday morning to present to you two topics that we think will be of interest to you. We've got about 14 folks already on. I'm going to give people another second or two to join. We think we've got about 45 or 50 participants in this webinar brought to you today by Crowe and EagleBank. Let me tell you that the effort here this morning will be to try to distill two topics that we think are of great interest in the current environment. One is a grieving moment for the end and the death of Libor and how that transition will impact the banks, the borrowers, and the market in general. And then secondarily, we have our friends from Crowe and Tim Trifolo discussing some of the current tax changes that will impact all of our lives, and obviously trying to distill that to the very essence of what you need to know to get on with your businesses day in and day out. Crowe's tagline is smart decisions, lasting value, and I think you'll find from the presentation from our friends at Crowe that they'll adhere to that. On our end at EagleBank, we try to live by the notion of relationships first. We certainly have an excellent relationship with Crowe, and thank all of you that have joined the webinar for the ongoing business that we have with you. And without further ado, I will throw it over to Mandy Simpson, who will lead the first panel, that grieving moment for Libor.
All right, thank you, Tony, and thanks again for everyone joining us this morning. I'll just echo what Tony said, that we welcome you all. We hope you find this panel insightful. And with that, I'll introduce my co-panelists. So I am joined, I guess maybe I'll start with myself, do a brief introduction, but my name is Mandy Simpson. I'm an accounting advisory partner at Crowe, and I'm joined by my colleague, Matt Geerdes, who works alongside of me in that group. And our focus from an industry perspective is helping companies through complex accounting issues. So whether that's new accounting standards or things like Libor transition that might have an accounting and financial reporting impact, we help companies navigate those complexities. And we will be joined today by Scott Clark, who is from the EagleBank side and leading the Libor transition initiative at the bank as in his role as treasurer. So, I think probably at this point in the pandemic, hopefully most of you are familiar with Zoom. And so you hopefully see that you have a chat feature and a Q&A feature that is available to you. So we welcome your questions. We want this to be valuable to you. We want to talk about the things that might be top of mind for you. So please feel free to use that Q&A function to send us any questions, and we'll try to address those either as we go throughout our presentation today, or we've also reserved some time at the end of our presentation to cover any Q&A that has come in that we didn't get through throughout the course of the presentation. And certainly if you have a question that maybe is a bit more bespoke or specific facts and circumstances, we can always reach out to you after the presentation to talk through that question on a one-on-one basis. But you all did join the webinar muted, so you won't have the ability to go off mute or come on camera and ask that question, but we will be monitoring that Q&A feature and do welcome the opportunity to engage. So with that, we'll talk through our agenda here, how we got here with Libor transition. Tony teed it up as the mourning and the death of Libor. I think depending on what side of Libor you're sitting on, I think some of the regulators and others are excited to see Libor go away, but certainly it's created a lot of operational challenges, and just in the midst of a year where we've all been dealing with a lot with everything else going on with the pandemic, has maybe been a bit of an afterthought. So we'll talk about how we got here and where we're headed. Matt will talk through some recommended actions for entities like yourselves to think about taking to make sure that you're ready for Libor transition. We'll go through some reference rate comparisons. So I know there's lots of questions about, what's replacing Libor and what does that, mean to my interest that I might pay or the contracts that I have tied to Libor. So we want to address that. And then Matt will wrap it up talking through some financial reporting implications. So what you need to think about from the accounting and financial reporting perspectives. So with that, Maybe we'll start with just a high-level refresher of and level setting of what is LIBOR, how is it determined, why is it going away? So I think we all probably know LIBOR stands for London Interbank Offered Rate, and it's really just meant to represent the average rate that banks would lend to each other on an overnight basis. And so you might think, well, hey, that sounds pretty straightforward. What's so wrong with LIBOR? And at the current point in time, and certainly even going back to 2017 when the decision was made to move away from LIBOR, a lot of regulation and a lot of monitoring had been put in place around LIBOR, such that people felt like it was appropriately regulated and probably was an okay rate to use. But, prior to that point in time, certainly in the, early 2000s, extending probably through about 2012, there was a lot of scandal around LIBOR as banks were kind of working together, colluding, if you will, to rig the LIBOR rates that were being used. And so because of that, it drove, increased regulation and scrutiny around the LIBOR rate. But it was just determined it was not a perfect rate. It was not a long-term solution for so many instruments to be referencing. The Federal Reserve has estimated that over $200 trillion of contracts are tied to LIBOR. And so the sense worldwide was that a more robust rate or set of rates needed to be used to underpin that amount of transactions that are so key to our financial system. So LIBOR in its current form is determined by a panel of globally active banks coming together at the end of every day and answering the question, at what rate would could you borrow funds or would you lend funds if you needed to do so? And those rates are submitted to an administrator. The administrator kind of kicks out the high rate, kicks out the low rate, averages the remaining rate together, and then publishes that rate that represents LIBOR. And one of the really big challenges right now is that those rates are oftentimes not based on actual transactions. So it's based on the panel of banks answering this question, but there aren't actually transactions occurring that underpin that. So again, it's still a lot of expert judgment and kind of guesswork, if you will. And so, the goal is to move to rates that really are more representative of actual transactions occurring in the market, with the expectation that will be, better and more robust for everyone. So a lot of times when people think about, LIBOR and they think about, okay, yep, I've got a loan contract or a debt contract that has LIBOR in it. I've certainly got to think about that. Maybe you've got some derivatives or hedges that are also tied to LIBOR, maybe related to that debt, or maybe, other hedging transactions. But LIBOR really can show up in a lot of different places. And so we've seen companies be surprised to find that maybe their lease contracts reference LIBOR, or maybe they've got a discounting model or a valuation model that's using LIBOR as an input. Maybe even compensation contracts that are tied to LIBOR. So those are just a few of the places that we see LIBOR popping up. So while it's very common in loans and securities and hedging, be aware that you may have other contracts that are, or maybe more surprising, that might contain LIBOR that you might also need to be aware of. So, what are some of the key actions that have happened associated with LIBOR transition in the past, and then what lies ahead on our future related to LIBOR? So it's hard to believe, at least for me, somebody who's followed this issue for what seems like a long time, that it was over 4 years ago that the FCA, which stands for the Financial Conduct Authority and is the regulator for LIBOR, they made the announcement that LIBOR would cease to exist after a certain period of time in the future. Originally, that date was going to be 12/31/2021 for all types of LIBOR. Subsequently, a decision was made to extend certain US dollar-based LIBOR that is really common. So those 1 month, 3 month, 12-month LIBOR tenors that are referenced in a lot of our contracts here in the US in particular. A decision was made to extend the availability of those contracts through June 30th of 2023. But anyways, we've been working on transitioning away from LIBOR for quite some time. In 2018, shortly after that FCA announcement was made, the Alternative Reference Rate Committee was formed. And that ARC committee is a US-based committee that was constituted by the Federal Reserve Bank and the New York Fed to come up with what the US was going to recommend as a replacement rate for LIBOR. And so as Scott and I will talk a little bit later in the presentation, that group has decided that the Secured Overnight Financing Rate, or SOFR, is the US's preferred alternative for LIBOR. And that group has undertaken a lot of activities to kind of encourage and support SOFR being available and a robust rate to use for LIBOR alternatives. A couple of other things that have happened, again, maybe a little bit outside of being directly tied to LIBOR that are really important to understand too. One, Matt's going to talk us through a little bit later, is the Financial Accounting Standards Board, or FASB's accounting standard that was intended really to just help ease the transition associated with LIBOR. For an accountant like myself that, kind of thinks about the complexity that could be associated with opening and amending $200 trillion of contracts, as you might imagine, that could be a huge accounting and financial reporting nightmare. But the FASB gave us what I like to call a magic wand to help us kind of just wave this wand and alleviate some of the burden associated with this transition away from LIBOR. So I view that as a positive. The other thing that's really important, it's certainly been really important to Eagle as a bank and the financial industry as a whole, but that's really relevant to you as borrowers and customers too, is the banking agencies came out last November and with an announcement that, among other things, drew a really hard line in the sand and said that financial institutions shall not originate new LIBOR exposures beyond December 31st of this year. And so even though there had been an extension of the availability of common tenors of LIBOR, the regulators were very clear that that did not mean that banks could keep originating new LIBOR exposures. So financial institutions have been in somewhat of a sprint this year to make sure that they're prepared to not originate new LIBOR after 28 days from now. But there will still be a lot of activities around, amending those legacy contracts and making sure we're all in a good position to move away from LIBOR entirely by that June 30th, 2023 date. So the dates that are standing ahead of us here are 12/31/2021 is, again, that date that all non-US dollar LIBOR and certain less commonly used US dollar LIBOR, 1 week and 2 month LIBOR, are going to cease to be available. And then we have until June 30th of 2023 for, again, the more commonly used US denominated LIBOR tenors to be available, but they will cease to be available after that date. One of the the other items I didn't specifically highlight on my slide, but I had as this March 5th, 2021 date. That was the date that the FCA, or the Financial Conduct Authority, said, hey, LIBOR is going to cease to exist after these two dates. And while that didn't mean that all of the contracts that reference LIBOR had to immediately cut over to an alternative rate, what it did do was set the date for which a fixed spread adjustment would be determined. And why this is important to you as borrowers potentially is that, to the extent you have contracts denominated in LIBOR that are going to be switching to SOFR, because of the structural differences in those two rates that Scott will talk about later, there needs to be an adjustment to kind of get things back to where they were before. So the intent with these fixed spread adjustments is to say, here's what the difference between LIBOR and SOFR were over the last 5 years, averaged out. And so these are going to be applied in these contracts that are going to move to SOFR, at least generally, to kind of get everybody back to an even playing field. So ideally, your interest rate won't change significantly. The banks or your lender's interest rate won't change significantly. So it's not intended to, really kind of do anything other than to get everybody back to an even playing field after the transition away from LIBOR. So these won't kick in until your contracts actually move from LIBOR to SOFR, but they are out there. They're published publicly and will be fixed at that point. So you can kind of look at these and know that they're not going to change between now and when your contracts do move to that new rate. So with that, Scott, I'm going to hand it over to you to talk specifically about Eagle's approach to LIBOR transition and where you are and what your customers might expect from you.
Thanks, Manny. Hopefully my dog is going a little bit crazy in the background here, but I can maybe talk through this a little bit. Good morning, everybody. Thank you for having us. As Manny mentioned, LIBOR became something that really over the course of 40 years, but certainly in the 90s and 2000s, that people didn't expect when they created LIBOR in the 60s. It wasn't ever intended or designed to have $200 trillion of notional value backed against it. And so once that amount of money came in place, the temptation to manipulate it and to use it just became too strong. And it was nobody ever envisioned it having that amount of notional value. Nobody had built any safeguards that could prevent it from being manipulated. So this is where we got to. Can you go back to one slide, Mandy? Yeah, there it is. So again, so that's why it's changing, right? It becomes something that nobody had expected. When ARC was created, the Alternative Reference Rate Committee that Mandy mentioned, they did have a lot of meetings. This wasn't just the Fed, but a lot of the major money center banks in the United States. The Federal Home Loan Bank was part of it. Obviously, ISDA, the Swaps Dealers Association, looking for what could be robust enough that if we wanted to have $200 trillion of notional value linked against it, what would be less subject to those potential manipulations by just a handful of market actors. In the case of in London, just a few banks. And so they settled on SOFR, which is again a rate determined by actual trades in the market of repurchase agreements selling government treasuries. So right now you can see obviously all rates are very low, but this is a very low rate. It's a secured overnight funding rate. Again, so it's a loan that's going to be paid off the next morning, and it's secured by the highest credit quality assets that the market knows about right now. In our case, U.S. Treasuries. And so, which is very different than LIBOR in that SOFR, it says it right in the name. It's the overnight rate, right? Whereas LIBOR comes in these tenors, which had an overnight tenor, but it had a 1 week tenor, a 2 week tenor, a 1 month, 6 month. I skipped 3 months for some reason at 1 year, and you can even see that it doesn't actually make sense for two banks to lend to each other for a year or for a 1 month term. There wasn't any volume of trades on there because banks don't need to borrow from each other for 1 year. We're going to be at work the next day, and we can just make a new contract if we have a new need. So the actual trades never took place. To get to, and we'll talk about this when we talk about what rates are coming. The SOFR does not anticipate trades of 1 month and 2 month and 3 month tenors. We're going to impute those from the futures market, so that brings in the CME. While all that was being constructed basically in 2019 and 2020, and that's why we've sort of got all that infrastructure in place. And so those 2021 announcements that LIBOR's ceasing to be published for all other denominated currencies at the end of this year. The United States, we have American exceptionalism, and we get a couple extra period time to finish our homework or whatever while we publish it, but we can't use the rates anymore. And this is pretty easy for the bulk of EagleBank's contracts because they are bilateral loan agreements. They're negotiated solutions between the bank and the borrower, whatever worked, and we can open up the documents. Obviously, it's mechanically challenging, but logistically and legally, there's not a lot of trouble. If whatever the bank and the customer can get an agreement to, we can find out. a lot of you, if you got a loan from us, a LIBOR-based loan between 2019 and 2020, you have in your documents the ARC recommended fallback language. So it will automatically, on the cessation of LIBOR's reporting, in this case, June of 2023, and you may have maturities that come up before 2023, and then whatever new documents are made at that point will have whatever language they have in there. But if you have one that extends beyond that date, at that fallback date, now that term, the spread adjustment is set. Mandy just showed that in the last slide, and the CME is publishing the 1 month tenor, or if you have a 3 month tenor LIBOR, that's being published daily now. It's in the bank systems. So anything that was originated between 2019 and 2020 with hardwired fallback language should work seamlessly. And I'll keep my fingers crossed. We'll maybe save a couple extra hours in June of 2023 to make sure that it all switches over normally, but it should be pretty clear from that. If you still have LIBOR documents and the fallback language hasn't been amended, and it's old language anticipated temporary cessation of LIBOR reporting, like a London holiday or some sort of temporary outage. So there's a lot of legacy contracts that have LIBOR language in there that is inappropriate to this situation of a permanent cessation. It's likely that your maturity is going to be before 2023. You're going to have a chance to meet with the bank and figure out what the new loan can be. But EagleBank pretty much stopped originating LIBOR loans in May. There might have been a few exceptions, and even your swap documents, if you have swaps based on your LIBOR loans and you swap back to fixed, you should have been party to an amendment to your ISDA. It was just an online check that you agreed with the ISDA's protocols, the International Swap Dealers Association, which manages all the swap contracts. You should have gotten that agreement that said, yes, when LIBOR switches, they will move to the ARC recommended language too. So that's pretty much where it lies. I do believe in 2022, certainly if you bank with Eagle, if you have other loans at other institutions, you're going to be going through that process if you haven't already, finding amended language. And again, to me, and what I've been recommending to our loan officers and our customers, it's time to cut to the chase. You don't need to make a LIBOR loan with fallback language. And again, you only have 28 more days to do it, because starting in January, you will just move to the alternative recommended rates. So, my contact information is here on this slide deck. And obviously you should know your EagleBank relationship manager, or just call the main line if you do have specific questions about your transactions and what you think is going to be happening. Well, other than that, I think we could turn it over, Matt, to your section to talk about some of these other recommended rates and what needs to be done between now and then.
Very good. Thank you, Scott. Appreciate it. Well, hello, everyone. Matt Girtis, coming into you from the Chicagoland area. So let's talk a little bit about some of those recommended actions from the commercial organization perspective. So while there's some similarities to what Mandy was talking about when it comes to the transition from LIBOR to other reference rates in an organization's contracts, such as leases or debt agreements or the ever popular hedge. What I have on the slide here, the perspective here is obviously a little bit different from the commercial organization. Since you may not have full control of the contract document and be able to unilaterally execute changes to deal with LIBOR. But regardless, there are some steps from the financial institution perspective that when you think about when it comes to commercial organizations, it really does remain the same. First is that you need to identify your exposure. How many contracts do you have that are out there that have a reference to LIBOR? It's very important to get this right on the front end, so you're not missing anything and could theoretically expose yourself to some unwelcome contract provisions, perhaps financial penalties. And of course, my personal favorite, the adverse accounting outcome. We don't want those. So, secondly, you really do want to develop that plan. Once you've figured out what sort of work needs to be done, it's normally not the best idea to just dive in without a plan. Who's going to own the project? What are your timelines? What sort of resources need to be pulled in from the organization to meet the plan's goal and its timeline? The rest of the steps on the slide, pretty self-explanatory with a few additional details I'll touch on. Obviously, after you plan, you need to execute and get the work done. We've all got a little bit of work on our shoulders. That's okay. But we really don't make sure that those contracts are amended to replace that LIBOR or add the fallback language if it's not already there. Taking a look at the accounting perspective on how all this is going to play out. And in a little bbit, I'll touch on ASC 848, some of those practical expedients, what I like what Mandy called it, the magic wand, when it comes to using some of these guidance to make it as painless as theoretically possible. It's never going to be that, but it makes it a little bit easier. And finally, the biggest thing is making sure that within your organization, letting the stakeholders know that how things are going, what sort of disclosures need to be happening. Maybe something has to pop in the financial statements. Maybe something has to go in a communication to the board. So all those very important. So let's move on to our next piece of the presentation, which is dealing with some of the rates as far as the rate comparisons. So Mandy, I think you're up.
Yes, I am. So we thought it would be helpful to do some comparisons of, the more commonly referenced LIBOR rates. So 1 and 3 month LIBOR are pretty common, and then compare how those rates, over time have compared to SOFR, and then also talk about some of the other replacement rates that you may be hearing about and may be seeing in your different relationships. So I think this will actually hopefully address the one question that's come through so far about, gosh, this seems like it's going to take a lot of time and effort and expense for lenders and borrowers. What's the actual financial outcome or financial impact of these changes going to be? And if so, what is driving any of those factors? So hopefully we'll be able to kind of address that question as we talk through this next section. So the first chart we have are with our friends 1 month and 3 month LIBOR. So again, these are rates that have been existent for a long time. This chart shows the rate patterns over the last 5 years, going back to March of 2016. And so you can see that the blue line, I believe, is our 3 month LIBOR. The orange line is our 1 month LIBOR. And so they, move pretty well in tandem over time. And, these are, kind of what we've been dealing with here. As somebody I think mentioned earlier in the presentation, maybe it was Scott, dealing with extremely low interest rates here in the, more recent periods. And so when I think about, well, what rates other than LIBOR might we see out there? We've obviously talked about SOFR, but, as I work a lot in the financial institution space, so more on the lender side of LIBOR transition. And so back in July, we did a survey of what alternative rates or other institutions considering. And so SOFR was certainly a heavy favorite and being considered by the vast majority of institutions. But we also saw a lot of institutions considering using prime as an alternative to LIBOR. I think that's a rate that they felt like their customers and the market in general was pretty familiar with. So maybe that would be a good alternative. There's also a new rate, a Maribor, I guess somewhat new rate that some are considering that is maybe a little bit more akin to LIBOR, but based on actual transactions by community banks largely, that is considered more consistent with how a community bank might actually fund their balance sheet. So, we're seeing a number of institutions at least consider a Maribor as a replacement for LIBOR. Maybe even moving to fixed from floating. I don't know that that's going to be wildly popular with borrowers, but certainly that may be an option for some. Fed funds effective rate, one that's not on this chart that's being considered is the Bloomberg short-term bank yield index, which is thankfully they gave it a shortened acronym BSBY. So I suspect that, again, as you're kind of looking through your various affected contracts, you may be hearing about a lot of alternative rates out there, not just SOFR. SOFR is going to be, again, probably most common based on what we're hearing from the ARC and others. So I thought it might be helpful to see, well, how has SOFR compared to, I think this is showing both, the 3 and the 1 month LIBOR. So taking that original slide that we had and then just laying over the yellow line, which is SOFR. And so you can see, SOFR, which I think Scott alluded to, hasn't been available as long. So it only goes back to 2018. And so we've added in, what SOFR is since that time period that became available. And you can see that by and large, SOFR tracks to what LIBOR has been. Generally is slightly less than what LIBOR is, which you would expect due to those structural differences that SOFR is based on secured overnight financing. It's secured by the, U.S. Treasuries. So, very, very secure, virtually no credit risk compared to LIBOR, which is an unsecured bank-to-bank rate. So again, that credit risk component is reflected in LIBOR. But I think we probably all can't help but notice there are at least 2 times that there's some very obvious divergences between the LIBOR curves and the SOFR curves. And so you're probably asking, well, what drove those particular divergences? Is that something I need to be concerned about? So the first one that really sticks out is going back to September of 2019, where we see this, again, relatively huge spike. I think it's about a 228 basis points fluctuation in SOFR in one day. And if you go back to that date, really the thing that's driving that particular spike was just a confluence of 3 different events. Part of it had to do with some withdrawals from the system due to some tax payments that were pending. That was exacerbated by some new issuances of a particular type of security. And so broker dealers who were dealing in and trading in that security were drawing down their reserves to, facilitate that. And then the third component was, I think there was also some actions on the part of the Fed, the Federal Reserve themselves, and some of the U.S. Treasury movements that they had made that just on that particular day really constrained the SOFR market and drove those rates up. It recovered the next day. It was a very short-term blip in the system, but certainly a very significant blip that was, again, driven by those confluence of those 3 events. If you fast forward on the curve, the next one that you probably notice is a time when SOFR actually moved in the opposite direction of the LIBOR curves, and that was in March of 2020. And I kind of jokingly say, well, gosh, what happened in March of 2020 that would have caused that? Of course, we know that was the onset of the COVID-19 pandemic. And so if you can think about, again, that structural difference between LIBOR and SOFR, you had this, probably expectation or concern maybe that there was going to be some stress on the banks from a credit perspective as we were heading into that pandemic. And so maybe those LIBOR rates, became elevated, would have gone up to kind of price in that expectation, while at the same time there was a flight to safety. The Fed was, kind of opening the liquidity floodgates at that point in time. And so it had the opposite effect on SOFR rates. So we saw those SOFR rates moving down at exactly the same time that LIBOR was ticking up. You can see that those did converge, later that spring and into the summer, and again, are now tracking on more of a normalized pattern. But again, there are some things, some market forces that are going to drive some differences in LIBOR rates, in SOFR rates compared to what we saw to LIBOR. And Scott, I'm going to hand it over to you to talk about a few of those.
So again, those main differences of being a secured rate, relying on government treasuries as this idea that there's collateral moving back and forth, and being overnight, being repaid the next day. So even, paying 5% for one day, 5% an annualized rate, but for one day is like 0.0014% or something like that. So yes, if you transition your loan or make a new loan that's based on daily SOFR, and you do have one of those nights, which again, very random. And in the case of that big spike, a confluence of multiple events and Fed policy and tax policy changing, you could see an outlier like that. But it, again, very quickly comes back into back into its other space and a normalized run rate after that, and wouldn't actually change your interest payment drastically. Again, now, I suppose I could imagine some world where that was a divergent and persisted more than overnight. But that's the benefit of it, right? Is that everybody is coming back to work and figuring out what the next thing that needs to be done is to bring at least a little bit of a sanity, or at least the best estimate of the future expectations of the value of time. I guess that's what interest rates are, the value of time, what they should be. Those various maturities that LIBOR has were, again, fictitious. They were not actual trades based on the market. It is true for Ameribor that, and the way community banks fund themselves, it does make more sense. Community banks will lend to each other at a week at a time, or a month at a time, 3 months at a time, but hardly a year at a time. And so some of those longer term Ameribors might start to suffer from that, a very thin markets, and not necessarily be as indicative of borrowing costs nationwide as they might otherwise be. And so SOFR is only overnight, and the correction to that is actually to use the derivatives market to try and put a tenor on SOFR's, making SOFR's futures, which we'll sort of talk about. And that, again, that will be important. And I have the link in here later that you can go see how many people want to read the white paper about how those derivatives are constructed, but I'm linked to it. That spread adjustment that Mandy mentioned earlier, for me and for EagleBank, we mostly made loans on 1 month LIBOR. Again, you have to make an interest payment every month, generally on your bilateral loan agreements. So 1 month LIBOR always made sense. That 11 basis point difference is trying to get into this number 3 here. There's a built-in credit component to LIBOR. There is no credit risk in SOFR. So that 11 basis point spread adjustment is trying to capture this idea that there are some credit risks, and they extend by the tenor. So the credit spread on a 3 month LIBOR to a 3 month SOFR, the spread is wider because theoretically you have more time to get into trouble or get into credit problems in 3 months than you do in 1 month. Like I said, LIBOR being partially transaction-based, that's true. Banks do lend to each other overnight. They don't necessarily lend to each other in 1 month tenor. SOFR is only transaction-based. That's the whole point of it. And again, $750 billion of underlying repurchase agreements based on treasuries versus, small amounts of interbank lending. Well, $500 million is a lot of money to me too, but relatively a small amount of money of interbank lending. So if you could skip to the next slide, I think we can see, I did mention some of this stuff. If you have a LIBOR loan that's pre-2020, you might need to check your documents or see what it says, or obviously just call the bank and they will do that work for you, and they'll send you the documents and see what it needs to be done. If you have that ARC replacement language, just understand, obviously know when the maturity date of your loan is. If it's pre-2023, you don't worry, you're going to make a new loan before all of this starts to matter anyway. If it does extend past 2023, hopefully that ARC hardwired language, the steps are all in place. I hope we did a good job making it, documenting them correctly and making them easy to identify. But it will switch to the CME's term SOFR. That's step 1 of the waterfall of even the ARC's replacement language. So then the next slide shows one more. Yeah, the next slide shows where you can find the information about daily SOFR. It's published every day by the New York Fed. You can see the volumes of trades and transactions that are underlying the index. It really has been 5 basis points throughout the pandemic. There's been a couple days. There was a few months that it was at 3 basis points, but 5 has been about where we've landed for a while. And LIBOR has been stuck at 8 and sometimes 11. But the term SOFR, which is the newest part of it, is again derivatives transactions, futures contracts that are published by the Chicago Mercantile Exchange, is CME, if anybody is checking. But they're publishing on their website. They'll tell you all the data. It's just transparent as it gets, and it's always available for you to check against the bank's systems too when you get your statement. So I think you can see there are a lot of differences to it. but as a practical measure of, having your principal balance outstanding, having a rate applied to it, finding an accrued interest rate, an accrued interest expense at the end of the night, compiling that into a statement at the end of a month, and getting your bill out there. Those mechanics have kind of been answered and solved at this point. Matt, do you want to?
Sure. All right. Well, let's think about under some of the reporting implications here. So US GAAP, which is so if you're interested, it's ASC 848. There are a few baseline concepts that drive how you're going to be adopting this into financial reporting. And, the standard itself actually is going to sunset after 12/31/22, because the theory is that, hey, after, everything has been transitioned and Libor goes away, well, then, we don't really need that standard in the codification. Now, the question is, are they going to extend that sunset date? They're not 100% sure at this point. So, but, some of the concepts that definitely should be foremost in mind is that when you amend a contract and there are cash flows, do you have a gain or loss situation from an accounting perspective? What's your change in the effective interest rate from an accounting perspective? Do your instruments have any sort of embedded features that may now need special accounting because they have to be bifurcated as a derivative? Or do you have any sort of VIEs, variable interest entities, or reporting any changes? And then, of course, what do you disclose? So now what the FASB, did was work through some practical expedients so that the implementation of the ASU wasn't too painful. Now, granted, it's still complex, but these do help when they applied, and it makes sense to apply them. But you need to make sure that if you want to apply the expedients, you have to stay within those guidelines, because otherwise you don't get to use the benefits. This has all got to be thought about when it comes to your transition plan that I was talking about earlier. So a couple of things let's talk about. Receivables and debt. If the only thing that you're changing is in the contract is that reference rate, and you left the rest of the contract alone, your debt service and your maturity, FASB says, guess what? Minor change. It's not a substantial change. You have to adjust obviously the effective rate prospectively, but you don't have to worry about any sort of accounting extinguishment gains or losses. But if you change something outside of that rate, in addition to the rate, guess what? The expedient goes away, and now you have to think about the accounting model for modification versus extinguishment. Now, when you're looking at leases and contracts, same basic concept. If you only change that reference rate, you can continue the contract as you had before. It survives that modification question. Now, for embedded derivatives, again, assuming all you changed was the reference rate and not the payoff provisions or the settlement provisions, you don't have to reassess whether or not you have to bifurcate it or not. Now, there's also a provision for if you're holding investments that are considered to be held to maturity. You can use a one-time expedient that the investment at the QSIP level, you can reassess and reclassify those as available for sale or trading, but the investment has to be held to maturity prior to January 2020. So now when it comes to some of the hedging things, there's a number of expedients that help you identify how you implement the standards, since we all know that these are some of the most complex instruments out there in practice. And what they really do is allow you for the change in the reference rate without causing an accounting issue when it comes to determining if the hedge is deemed to be effective, such as modifying the benchmark rate, changing the method to use assess effectiveness, rebalancing, just to name a few. So on our next slide, this is what we talked about, those potential impacts and the expedients. Let's look at, the changes that fall within the guardrails of actually using the practical expedients. Certain items are going to be considered by the standards to be reference rate reform items. And if it does, you're in the standard, you can potentially use the expedients. Now, this is a really great flow chart that I cannot take credit for writing, but one of my colleagues at the firm did that. But if you need to print something out of this presentation to help you think about the implementation, this is definitely the slide to do it. You start with the basic question of what is the change in the contract impact? If there's no change in the cash flows, you stop. Now, if there's a change in the cash flows, you look to the next question. But if it's related to reference rate, you can look at the practical expedients. And if it's not, then you got to go outside of the standard and you have to apply modification areas of other US GAAP, such as 842 or 310, 470, whatever the case may be. So now it gives you specific items, what are considered related to reference rate reform. That's on the slide. You have to compare the changes you're looking at to see if it's within that list of acceptable changes, or if the standard says that is clearly out of bounds. So I want everybody to keep these in mind on the next slide, because we're going to do a little bit of a case study / quiz. Not too hard, I promise. So, but keep it in mind. So as you look at this example, we have our face shield companies to modify its existing borrowing arrangement with its lender because it references 3-month LIBOR. Now, part of modification, you're moving the contract's moving to SOFR. The interest rate spread is adjusted to neutralize the effect of the change from LIBOR to SOFR. The capacity of the line of credit is increased by 10%, and you have a few grammatical errors that were corrected. So if you think about that, is this eligible for that practical expedient? And if you hit the button, Mandy, the answer in this case actually is no, it is not. And the reason why is that you look at that third bullet. You increased the capacity of the line of credit. That is irrelevant. That is not related to the reference rate. So therefore, right there, you're out of bounds. You have to apply modification versus extinguishment accounting when it comes to this particular debt instrument. So that's an example of what you have to think about when you're doing step-by-step basis on looking at your contract. So here in summary, we've got the standard with some of its important reminders. You know, it's in effect now, and right now, like I said, that sunset is 12/31/22. It covers its modifications, and it also covers that one-time election for held to maturities for debt securities that you're holding as investments. So you want to look at making sure that you don't want to make sure you're blending ineligible modifications with those eligible ones. And then, once again, as we talked about too, replacing a floating rate with a fixed rate, it's okay if you're just simply replacing that rate, but you're using then the last published rate of that floating rate. So also, think about this. It may make sense to not apply the practical expedience based on your individual situation. So that's just something that needs to be thought about as you're going through the process. So with that, I think we are at our Q&A point. So if we want to throw that open.
Yeah, Matt, thanks for covering that. I think maybe just the one thing to iterate that very last point you made, that it may make sense not to apply the practical expedient. A lot of the times we get questions that, gosh, I'm going to be spending all of this time and all of this expense to sit down with my borrower, sit down with my lender. Maybe I want to go ahead and adjust these, other things so that I don't have to incur that cost a second time. So certainly, as Matt said, it's optional to use that relief. You don't have to. And so it may make sense to, not avail yourself of that, but just wanted to make sure you all were aware of that so you could do it thoughtfully. We do have a couple of questions in here, and I think, Scott, these are probably targeted to you. So maybe I'll just let you unmute and address these as you see fit.
Oh yeah, I did forget to, I was happy to answer the question, but I did forget to mention, I always have, the best part about being the banker is that I always have that out where I can say, just go consult your accountants. I can always just tell you have to go ask Mandy and Matt. But a couple of the questions, I don't know if can other panelists see it, or do I have to read them back? Or?
Yeah, no, they cannot see the question. So yeah, it'd be helpful if you tee it up. Okay,
so the couple questions in here are asking about the practicalities involved, the time and expense of redocumenting, and then who's sort of going to be bearing the brunt of those costs. And then the second part of it too is about essentially spreads, and will the spread margin that banks demand over and above LIBOR, and certainly over and above the 11 basis points, again, which we colloquially refer to as the credit spread, for going from these, again, overnight lending markets on AAA rated securities to lending to various businesses, real estate developers, pizza places, gambling establishments, now that DraftKings is legal in most states. So those credit spreads that the market demands. And so to tackle the first one about the costs of it, the ARC recommended modifications, again, is a pretty straightforward documentation switch if the bank and the borrowers can agree to it. Getting it documented, the language has all been sort of in place. And so it can be done and documented again, very cheaply, and the bank's been paying for a lot of it ourselves. Certainly with new originations, when you're paying for all the other parts of the loan agreement, and it's just sort of been embedded in there. But getting a modification is not very costly, and in a lot of cases, the bank's been doing it now. If you go back and you're opening up the documents for other reasons, other credit considerations, changing the term, changing the maturity, the bank is going to be re-underwriting it again. That's going to be a different story, and you'll come up with what works there. But as far as banking is a spread business. That spread over and above LIBOR is what the bank is sort of counting as its net interest income to an extent. We're also not subject. We don't get, nobody lends to us at 5 basis points. Obviously, some depositors lend us money at 0 for non-interest bearing accounts, but a lot of them have money markets, and we're paying between 5 and 12 basis points for money market costs. So our borrowing costs are not also, and then we have FHLB advances and CDs and other kinds of rates that make up the bank's borrowing capacity and spread that we can charge on there. So it certainly it will be a turbulent time in 2023, but LIBOR didn't become the dominant standard overnight either. There were obviously other rates, that prime being a big example of them. And back in the 60s, when LIBOR was around, every bank had their own prime rate. Yes, there was the Wall Street Journal prime rate, but lots of banks could set their own prime rates as well. So there was lots of competing standards until LIBOR sort of dominated unexpectedly to at least the creators and the people who were originally using LIBOR. And so those standards that Mandy mentioned will be competing for dominance. I think SOFR obviously has a leg up, being connected to as connected as it is to government funded and money center banks. So that's where I'm backing. Obviously, we're already originating SOFR swaps and SOFR loans, and our recommended fallback language that we use with SOFR. So I do think that will end up being the dominant standard. And as far as what that means to return to a borrower and the borrower's costs, banking is still a competitive industry. Interest rates are still subject to the supply and demand for money, and the competitors who want to either make certain kinds of loans more easily and they'll cut their spreads, or they want to discourage certain types of lending activity and they'll raise their spreads to try and dial in that amount of loan demand or pushing loans off their books at the case. So that becomes the nature of a marketplace at that point.
All right. Well, thanks, Scott, for answering that question. I know we're a couple minutes past time, so thanks everybody for hanging on. Thanks for joining us today. Again, as Scott, I think, mentioned earlier, we wanted to make sure you all had our contact information. So if you do have additional questions or things we can help with, feel free to reach out to any of us. And for those of you who are going to be sticking around for the tax update from Washington, we're going to take about a 7-minute break and then restart with that update at the top of the hour. So hopefully we'll see you back here for that. Thank you.
So I'm going to start out by asking my partner, Rochelle, to go through this is the key in my mind, view from Washington. And we follow this stuff really closely, Ryan. And I have to say that, I've come up with this formula that says 3 days away from this takes 3 days to recover. With the velocity and the amount of things that have been changing and sort of the interdependencies between the items that are in what you hear about coming through in Washington. Part of it is tax, but obviously other parts of this have to do with social programs, everything from healthcare, childcare, employer benefits, corporate tax provisions. There are a number of different agendas happening. So even as a professional that has my nose close to the grindstone on this, generally working with the Real Estate Roundtable, Tax Policy Committee, and other things, it's just so much to take on. So we wanted to try to distill a lot of this for you. And Rochelle's going to take us through really where are we, what is happening, and what to expect, at least best knowledge we have now. And then from there, we're going to try to just pull out the major pieces that we're talking to our clients about on a daily basis, and how businesses might apply that thinking in their strategies. So over to you, Rochelle, and I will advance the slides. This is us. We will send you the slides afterwards if you'd like. Here is our agenda. And I'll spend just one more minute, sorry, Rochelle, but here we'll start with View from Washington. And this, I wanted to just spend a minute on the agenda because of the interdependencies. We're going to talk about that, but I'm also at the bottom, Build Back Better framework at the top. That's where we are now. Infrastructure bill, that's where sort of we've been, but it's still lingering. Energy efficiency and tax incentives is kind of where we want to go. And then finally, bringing this all together, how do you distill all this information and what do you do with it as a business? So Rochelle, thank you for your patience. Off to you.
All right, well, thanks, Tim. Next slide would be great. And the next slide. So I think, speaking to a Washington Bethesda-based banks, clients, it's a little different than when you're trying to do a presentation that's sort of nationwide, because as all of you know, we sort of all know somebody who works for the government, either it's a spouse or a neighbor or a friend. So we've got sort of a little different perspective and are probably more in tune than a lot of folks might be. But I wanted to try to just put together from a tax perspective how we're looking at what's happening now in Washington and on Capitol Hill. And one of the challenges, to Tim's point, is the topics that are being addressed are so broad and so sweeping that in order to be able to keep up with anything, I try to narrow my focus down to the tax world. It's the only way that I can manage. So we're going to be speaking today really from more of a tax perspective. And Tim and I went through a discussion on our chat, our internal chat, during the break about sort of how we see this all playing out. And Tim has a triangle view of how all this is working, and I'm sure he'll explain that. But I see this as 4 parts, so I was saying, no, it's a square. Mm-hmm. I think the one thing we do know, and probably the only thing that we know right now from a tax perspective, is what was enacted in the Bipartisan Infrastructure Investment and Jobs Act. That was signed into law on November 15th, 2021. There were very few tax provisions in that. And I wanted to highlight 2 that might be of interest. The first is the termination of the employee retention credit for at the end of the 3rd quarter of 2021. It was supposed to continue through the end of the year. It is not. IRS has said that they will provide guidance on how taxpayers should deal with this, because as you can see, November 15th is well into the 4th quarter. We're not going to get into the specifics right now on this particular topic, but I'm sure for a lot of taxpayers, they have questions about how to deal with this. The other is digital assets. I don't know how many folks are into crypto, NFTs, EFTs, whatever your favorite virtual investment might be. But there will now be broker reporting with regard to digital assets. We're waiting for the rules on that, because 2 of the definitions that are really critical to this provision, what's a digital asset and what's Treasury going to include in the definition for purposes of guidance that they put out. Will they sort of take a broad approach and try to be all inclusive? Will they try to phase things in? Maybe starting with some of the cryptocurrencies that they've already provided guidance on, convertible crypto like Bitcoin. Who knows how that's going to work. The other thing is who's going to be a broker. This is one of the issues that really caused a lot of consternation as the bill was going through Congress. Miners, those involved in the DeFi space of digital currency, were very concerned about one of the primary obligations of broker reporting, which is to find out who the payee is and to have that information. You need to have relationships, folks in banking, of course. You guys all know about broker reporting. Folks who invest, you understand the W8, W9 concept. This doesn't necessarily translate in all the digital asset spaces. The Congress has, folks in Congress have talked about perhaps amending the broad definition of broker that was enacted. It's unclear what will happen. And as we talk about the next three bullets, it's possible that a fix, if you will, or a narrowing of the broker reporting definition could show up. It's certainly something in the conversation. The other thing is, for those of you who deal with the non-SARS receipt of $10,000 in cash and filing the forms 8300, that also has been extended to digital assets, where digital assets are going to be treated as cash. It's unclear how the IRS will implement that. My question is, will Form 8300 still be used and you'll just have digital assets? How will digital assets be valued? Or will there be a new form? So I think there's lots of questions. These rules will apply to reports required to be filed after December 31st, 2020. In the case of broker reporting, that's going to affect transactions, 2022, I'm sorry, that will affect transactions during 2022. For broker report, for the $10,000 reporting threshold for recipients, that's more likely something that won't be effective until receipts in 2022. So that's the stuff we know. That's the only thing we know is this Bipartisan Infrastructure Investment and Jobs Act. And I know Tim's going to talk a little bit about that because there's a number of nice energy and other incentives included in that bill that folks are going to want to hear him talk about. The next thing is the Build Back Better Act. That's what's currently being debated in the Senate. A version of Build Back Better passed the House November 19th. The Senate has taken up the bill, and there is very little confidence that folks know what's going to end up coming out of the Senate. Leaders in the Senate have talked about having some text language for that bill, perhaps next week or the week after. It will be interesting to see what provisions are the same as what the House passed, and what new or different provisions are included in the Senate version. Some of the real sticking points are the relief from the $10,000 SALT cap. The state and local taxes are limited, the deductions limited to $10,000 under the Tax Cuts and Jobs Act that was enacted in 2017 and effective beginning in 2018. The larger states, high tax states, Maryland would be included, are looking forward to perhaps some relief for that. That was something that some leaders in Congress said, yes, we're definitely going to give relief for that, but that's been a real sticking point. Another sticking point, at one point, so just to back up a little bit, the Build Back Better Act, as compared to the Bipartisan Infrastructure Investment and Jobs Act, is more the current administration's piece of legislation to enact their agenda items that did not get bipartisan agreement. So you have the bipartisan bill were generally the things that people could agree on both sides of the aisle. Build Back Better includes the items that are Democratic priorities of this administration. And this act is going through what they call the reconciliation process, which in the Senate, which is a process that generally has very particular rules that the Senate parliamentarian will adjudicate whether or not the provisions meet the rules. Generally, there has to be a revenue effect for each of the provisions. If there isn't, then you can't include it in reconciliation. And the benefit of reconciliation is that you only need a simple majority to pass the bill. And in the Senate, as folks know, there is a 50-50 split with the vice president to pull the majority over to the Democrats. So there's a lot to unpack in the Senate about what's going to be in the Build Back Better Act. There are also divisions among the Democratic Party. There are, liberals, moderates, conservatives within the party itself. And so those divisions have created some challenges in the Senate, but that also means that some of the provisions in the Senate are likely to be different than the provisions in the House. Even if the Senate enacts something before the end of the year, or passes something rather before the end of the year, it will have to go back to the House. The House and the Senate are in communication now, so hopefully whatever gets worked out in the Senate will find agreement in the House. There are those in Congress who are skeptical that this bill could get over the finish line before the end of the year. For those of you who were impacted or watching the tax landscape in 2017, the Tax Cuts and Jobs Act, TCJA, was enacted on December 22nd, 2017. Some of the provisions, even if they weren't retroactive, had retroactive effect, particularly some of the international provisions. And so for businesses going into the 2018 tax year, that first quarter, or calendar year rather, the first quarter was difficult to say the least. And then what we had for effectively 2 years was new and changing regulations coming out all the time, and folks trying to absorb those. That was not just an issue for practitioners to try to understand and absorb those. It was also very difficult for taxpayers to try to figure out, how they're going to move forward with things. And just to round things out, I'm going to go quickly so I can turn it back over to Tim. There's the continuing resolution. The government's funded through February. Yay. We don't have another shutdown. I have lived through, I think, almost every month since the early 90s. I think I missed one. And this continuing resolution has to do with the appropriations. And so the rancor that was involved with getting the continuing resolution enacted, and the divisions that you saw within the Democratic Party, or potential divisions, are symptomatic and are certainly going to impact the discussions and the work on the Build Back Better Act. And then you've got coming up at some point in time, the date is not really that fixed. You've got the debt ceiling issue that the government needs to deal with. So there's a lot going on. Each of these bills has the potential to be a vehicle for tax legislation. And so this is what we're trying to keep track of. Tim, I've spoken a long time, so I'll turn it back over to you.
Oh, that was great, and there's no other way to do it but wholesomely as you did, and thank you for that, because there's a lot there. I mean, this is the thing. What I was saying, 3 days and 3 days, is that the interdependencies both in the process, meaning there was a big celebration of the bipartisan infrastructure passage, and then immediately kind of a block in the road as it relates to the reconciliation process going forward. From there, the disjointed, sort of politics and the procedural infighting that happens there. But also just, it seems like from a tax practitioner's perspective, at one point I look at this and say, this isn't bad at all. Look, there's only 2 things in the infrastructure package that are really tax focused, right? On the other hand, when I look at the bill from a demand driver and from a business perspective, and I think of Eagle's client base, I think of a lot of the clients we work with on the construction, real estate, private equity investment side, and I see the demand drivers that are embedded in there. And this gets at the triangle that I'll talk about, that you mentioned earlier, about demand drivers. So it's partially about, okay, well, there's not a lot in the infrastructure package that impacts my corporate tax rate, for example, or my individual tax rate, but look at all these spends and how am I going to take advantage of all that? But going back to, just the range of issues you touched on, I mean, we're talking about cryptocurrency and NFTs and things of that nature as one of 2 bullet points in the infrastructure package, which are things that a lot of lay people in public don't even know how to begin to understand cryptocurrency or NFTs. But yet that's one of the tax pieces that sort of sticks. And then go forward to, how do I analyze this as an organization? Because I've got stuff that is specific to my ownership structure, corporate tax rates, issues with respect to partnership and flow through items and benefits that come from those things. And then what am I investing in, or what type of product am I making? What are my operations, and what is deductible, and how do all of these employer benefits from the PPP all the way down to the retention credit and everything in between? There's just, it's so easy for me to sort of dial it in and say there's not a whole lot here. And then on the other hand, when you sort of read through the pages, there's an awful lot there to think about, from the 1040 where the rubber meets the road as the individual, all the way through an investment or a corporate structure, down to the ultimate operations and investments in the business. So there's just so much volatility to come there. And I guess I'll turn over to you, Ryan. I mean, when you're encountering clients in the marketplace, how much do you see this noise in the system? And there's a lot of noise, but there's also a lot of opportunity. And we've at Crowe sort of taken this approach recently as a somewhat of a mantra, is to sort of embrace volatility and look for the opportunity in times like this, which I think there are, that we'll touch on. There's plenty of opportunity, but on the uncertainty point, how do you see that impacting your clients' decision making?
Sadly, Tim, it's just another point of uncertainty in the world we live in today, right? I mean, over the last couple of years, obviously, we've been dealing with this unprecedented situation, this global pandemic. that created a huge amount. We saw it in the last session with the March of 20 interest rate impact on the LIBOR side, and tax planning, especially in the commercial real estate space. Everyday activities are driven by tax planning, right? So to the extent that there's more uncertainty in that space, it leads to more uncertainty in actions. Earlier, this year it was contemplated that this current administration would perhaps get rid of the 1031s as an example, and that's that conversation has quieted, if not gone away, at this point in time. But who knows what's going to change. To Rochelle's point, it's the conversations are day by day, hour by hour, frankly, and just leading to it. So we're, I like the phrase of just embrace the volatility. We try to make decisions based on what we know and as much information as we can gather. And that's what we'll continue to do. And having good, strong partners like Crowe in our back pocket is the only way to go through times like these, in my opinion.
Well, thank you for that, Brian. Perspective is really helpful. And I too focus a lot in the real estate space. And, I would say, to Rochelle's point, 2017 and the Tax Cuts and Jobs Act, in my view, as it relates to real estate, was favorable, full stop. I mean, we were able to preserve things like 1031, enhance things like bonus depreciation and cost recovery, favorable rules on 199A and 20% exemption from pass-through. I mean, most of real estate is done, save for REITs, maybe in partnership or flow-through form. And so I would think I've always held that real estate, in comparison to other alternative investments, private equity, pure play, or VC or hedge, the asset class itself is so tax driven that the marginal benefit remaining after the Tax Cuts and Jobs Act in 2017 for real estate increased over all other alternatives. That's my opinion. And all of the fundamentals of real estate tax planning were either preserved or maintained. I mean, there's a few exceptions here or there. But as we watch those things come through, that gets back to my point. We're safe on 1031s. We had the spike. I mean, this just goes to show the sort of range of change. I mean, we had that period of time where the Biden proposals turned into potentially taking capital gains up to the same as ordinary income rates. And you could imagine that on top of the carried interest legislation that keeps coming up, created a real spike and a real level of concern, especially around 1031s and whether you can use those or not. The other piece to this is the upstairs all the way through the continuum is the estate planning and whether or not there's a step up in basis at death that might go away, which would be huge, a huge impact in the real estate space. So
but Tim, let me just interrupt for 1 minute. I don't think there's anything that's a done deal. When you were talking about rates, there is discussion that perhaps a small increase in rates, maybe not to capital gains, maybe just to the marginal rates for corporations, might be in the offing as a simpler replacement for what the House passed as the book tax, the book minimum tax. And so I think, to your point, there is not a lot of certainty about what's safe and what's not safe. So I think planning and looking at contingencies and seeing if that, then this, I think is really the way to play this right now because of all of the unknowns.
Yeah, I agree. I think we agreed on three sort of bullets as to say, if you fast forwarded this and say, what's the punchline to some of the things we can drill into in more detail, is stay informed and connected and watch the progress. stay close to your advisors, do the modeling, the before and after, the contingency planning, and be ready to look for those opportunities, which we'll talk about in a minute. Let me just see. I had some other notes before we go forward, but maybe I will advance the slides and keep going here to talk about some of the specifics. And these, again, this is a select group, and we do this sort of by entity type first. But again, the challenge in the holistic analysis is from investment or operations through the entity structure and then up to the investors or individuals. So each of these sort of different categories within the bills impact both ultimate taxpayers, investments, and their activities, as well as an entity structure. So starting with corporate, Rochelle, you just mentioned maybe a substitute for this aspect of a minimum tax. This is getting at sort of taking it back to a policy perspective, and really the two primary pay-fors, if you will, as part of the Build Back Better framework, are to tax large corporations and high net worth, or I'm not sure what the appropriate buzzword is, but some of them are more friendly than others, or tax the rich sort of concept is at the one end of the spectrum. So that here, I think the minimum tax is a 15% tax. There's all kinds of complexities when you look at aggregation and multinational or multi-divisional companies as to how this might work. But here the idea is to try and tax corporations higher without actually just raising the bottom line income tax rate that would impact all corporations. Stock buybacks, there's a lot of abuse in the press that gets talked about in terms of, say, airlines, where they get government incentive and then raise operational enhancements and then buy back stock. So this is an excise tax that's proposed to avoid some of that, what's viewed as abusive behavior. Interest expense limitations. I mean, I can't think of another category that has gotten so twisted up recently, Ryan and Rochelle, as it 163J, or the interest expense limitation as we knew it before, was around for a long time. It seemingly got better, but operationally it almost got worse because the magnitude of the interest limitations. Here's again one of these positive carve-outs, Ryan, for real estate, other than for real estate had some significant limitations under the Tax Cuts and Jobs Act in comparison to no limitations other than the 163J in the past. Real estate, we had opt-out provisions, and those are still in place, but here we have a whole nother set of rules targeted at looking at a lot of this has to do with cross-border flows and limitations on deferring income offshore or avoiding having income come back onshore. So to keep that moving ahead and not get too hung up on those things, we can certainly come back to any of these and move to the individual provisions. But I wanted to also validate your point, Rochelle, that 2017 and the operationally, I'm not thinking of it, I'm not saying the right word, but bringing that to life, the 2017 changes through the tax returns, through the reporting, through the footnotes, the tiered calculations and things of that nature, in addition to adopting the regs over that 2-year period, was no small task on organizations or tax practitioners. And it seemed like we just kind of got in a groove over that. And then the Biden proposals came out. I mean, it literally was not really any dry ink on a lot of that stuff. So there's just so much to think about here. Again, when you sort of dial out the lens. Individuals, I think the key points here is the top bullet, meaning the biggest of the pay-fors, is this 5% surtax on an AGI of more than 10 million, which gets stepped down for different filing classes, et cetera. But a 5% surcharge, and 10 million sounds like a lot. It's a lot to me. It's, I guess, if you look at K1s and investment partnerships and hedge funds and PE funds and things of that nature, it's not maybe so much, but that's something that's certainly significant for the high net worth individuals to consider. And then the net investment income tax expansion. This 3.8% is a sneaky one. It's not an insignificant number. It's not capped. And it is really commonly referred to as the Obamacare tax, which is the pay for some of the healthcare initiatives there. The expansion here and sort of sharpening the pencil on this one, Ryan, is the biggest takeaway here. As you can see, I asterisk the point, is this pulls in a lot of real estate oriented businesses that in the Tax Cuts and Jobs Act over time, the real estate have been sort of protected from the application of this tax. But now this is going to come into play for real estate also. So this is something we're looking out for in that from the industry perspective. Excess business loss limitation. I mean, this one, if I had a highlighter now, I would just sort of go back and forth over it, because this is where the things get sneaky, and this is where the modeling comes into play and the contingency planning, because the loss limitations are another thing that have been sort of all over the board, and incentives and sort of relief provided by NOL provisions during the CARES Act and COVID responses to allow more flexibility to carry back NOLs, for example. The excess business loss, again, is a 2017 Tax Cuts and Jobs Act piece. But in effect, I mean, to bring this one home, one of the tax planning strategies used a lot by real estate oriented folks is to be a real estate professional, which allows to deduct or to sort of go around some of the passive activity losses rules and really take a maximum depreciation approach. The most depreciation you can get the soonest, the best. And if I'm a real estate professional, I can use the losses I'm getting from those activities against any income on my 1040. And so we had some real major portfolio income, W-2 wages from another spouse, for example, wiped out. And here this loss limitation came in to play during the Tax Cuts and Jobs Act to limit your ability to do that to something like $500,000 to which is real major change at the individual level. So this is where I think looking at the more tax planning for zero, in effect, is what I think is ideal when it comes to it versus loss generation that may end up suspended and quarantined somewhere in your structure or at your individual investor level. And so tax planning to get as close to zero with this excess business loss limitation is a real major thing to consider for individuals. SALT deduction cap increase, Rochelle, you talked about the high IRA balance is somewhat of a targeted provision, so I'm not going to spend a whole lot of time on that one. Let's move on. I think for comp and benefits, it may be best to just say there's a lot here. If you're not talking to your HR folks, your benefits people, et cetera, you should be. And so we will kind of move on from that in the interest of time. And Rochelle, can I ask you to see if you think anything here looks like worth bringing up?
So I'm looking at the 174 capitalization requirements. I know from my R&D colleagues, this is really important to many manufacturers. And so there is a big push for this. This will, it's supposed to come into effect in January. So if we don't see legislation by year end, I know there's a large group of taxpayers who will be really unhappy about this. The 1202, I know that there is for folks likely in the real estate business, cashing out and such, this change would affect a lot of taxpayers. And then the increased funding for IRS enforcement. There has been a large debate about how much revenue that would raise. One of the issues that's sort of one of those nerdy Washington issues is whether or not this item can get scored so that it's an offset for the bill. So one of the things that's being argued about in the BBB is how much is it going to cost? So this increased funding, if it's not scored, doesn't provide the administration with this neutral reconciliation bill. In fact, there'll be a cost. We'll see how this works out in the framing, but the administration effectively says even without the scoring, we know that this will raise a lot of money. One of the things we've seen in the real estate space, in the private equity space with, for the opcos, we have seen a great increase in enforcement and audits in the partnership space. It's just been really significant for many partnerships. For years and years and years, they never had audits. That's all changing. The IRS also has this large partnership compliance initiative that's going on. So I think this increased funding for IRS enforcement and reliance by the administration on raising significant revenue is something that folks need to watch out for.
Yeah, thanks for that. And one other item on here is the modify the portfolio interest or portfolio debt rules. And this one is, I'll just call it out, is a big deal for non-US investors in private equity generally and in real estate very specifically, where the portfolio interest structure is used as a capital structure in US corporate blocker structures that are set up to hold real estate and other similar assets like infrastructure and other sort of effectively connected income generating assets that may otherwise use a corporation. Oftentimes those corporations are leveraged and equity investments are split into debt and equity, and this portfolio interest rule, if it sticks and it seems to be hanging around, would have a major impact on that. So keep your eyes on that one. International, this is, again, we're going to kind of, in the interest of time, go past this because most of this stuff is really large multinational. Amazon doesn't pay any tax, GE doesn't pay any tax, sort of targeted on the outbounding of IP, offshoring, and keeping cash outside the US for tax purposes.
But again, Tim, just to make a couple of points,
yeah,
we've noted a lot of the international provisions affect a lot of our clients that are in the manufacturing space because of the relationship overseas. One of the gifts that the House gave to folks was a delay to that 2022 date. Initially, that stuff was supposed to be immediately effective. So those are two things, depending on your focus, that you'll hope will stay in the Senate.
Great points. And here, this summarizes basically what you had said earlier. There's a lot more in here, which I'm going to touch on in a minute, not in a granular way. But if anybody would like to talk about this, what we are talking about here today from an industry perspective, a lot of industrialized data we have and information. So if there's anything real estate or otherwise that anyone would like to talk about afterwards, please let us know. I think one of the things worth mentioning, Rochelle, is to just touch on what's your perspective, because there's almost this like third leg to the stool that keeps being brought up when you talk about enforcement, partnership audits, Partnerships generally weren't audited in the past because they didn't pay any tax, but this view as the partnership is sort of developing view of partnerships being viewed as the vehicles for bad tax planning and that type of thing. Not maybe it's good tax planning, but bad actors, if you will, is sort of generating, and a lot of that, it feels to me like it keeps coming from what I described almost as this third leg of the stool with the Senator Wyden proposals, and some of those are sort of razor sharp in terms of their application and pretty significant in terms of their impacts. I mean, how do you factor that in or not?
So I don't view this as an attack on partnerships as necessarily bad actors. When you look at partnership structure, there's lots of opportunity, if you will. The main thing about partnerships is they are so complex, and the structures and the ownership interests and the allocations make it very difficult for the IRS to sort of see through where the ultimate tax-paying beneficial owners' tax liability should be or is. And so in the examination function, it's very difficult. The other thing that has happened over the years is that more of the economy, more of the assets, more of the value of taxpayers today has moved into corporates, into partnership structure. I mean, it used to be that corporate structure was where all the economic engine, if you will, existed. And so in like 2013, 14, Congress started getting really antsy about the fact that IRS did not have a baseline for knowing where non-compliance might be in partnerships and how much there might be. They couldn't even quantify it. And so there was a drive to try to give IRS tools to try to sort of see through that and be more efficient in their audits and figuring out where non-compliance is. So I think it's this complexity as well as the increased prevalence of partnerships in the economy that really is driving this focus on partnerships. And then when you mentioned Wyden, I think this is just another effort to try to make partnership simpler. Some people, though, might view all of this as an incursion on partnerships as an entity structure. So that I will leave to folks who deal with those structures more, but there is some concern that there is an attack on the structure for whatever reason. I believe it's the complexity and the fact that it provides opportunities, but I will leave that to you.
Yeah, I mean, there's the amount of partnerships. I mean, as you say, it used to be real estate was sort of the primary driver for the use of partnerships. Enter sort of the massive blow up in growth around alternative investments, private equity hedge and otherwise, and think of most of those vehicles are at least at the fund level partnerships. And we're seeing more and more of the acquisitions by private equity funds being structured either purposely or coming to market as partnerships, which is really interesting. So there's a lot there in the flow. And so I wanted to just kind of go back to something that you mentioned, Rochelle, early, is the SALT cap. And wow, I mean, we're talking about crypto, sort of assets, digital assets, and then partnerships and state and local, and complexity has grown dramatically at the state and local level, with states trying to find ways to raise additional revenues through alternative types of taxes, et cetera. The tax partnership compliance for partnerships is increasingly difficult for state and local. But wow, look at the SALT cap, combine that with the pandemic, the SALT cap 2017, Tax Cuts and Jobs Act again, pandemic, and then sort of a flight from cities and space coming around the same time. What an amazingly sort of dynamic and powerful tax issue that drove so much behavior and influx to Florida, to Texas, and others out of cities like where I'm sitting today, New York, for example. I mean, it's just pretty amazing to think of the deduction of state and local taxes having that type of bubble up effect. So we're getting close on time. I think what I really wanted to just do in the last couple of minutes is, these are some visuals. There's so much information here and so much changing that we thought we would just spend a minute touching on where things are going. I mean, the policy in the beginning, the Biden proposals felt to some of us like sort of this grab bag of tax increases and revenue raisers without a whole lot of policy interwoven. At least that was the way it felt to me. And I was looking for this. And now, as things have evolved, we're starting to see the policy and the agenda items, like Rochelle mentioned earlier, come to life. And a lot of us tax practitioners and people focused on tax for an entity or a business don't necessarily look behind. We look at the individual provisions, we look at the business provisions, and then we sort of stop. But when we stopped last time, the Opportunity Zone program was kind of behind everything where we stopped, and look at how much life and energy that has taken on politically and from a tax perspective. I would say in the energy efficiency area, that's the area to watch for all businesses. I think if you look at the triangle that I talked about before, was Build Back Better, I view sort of at the top of that. Where are we headed with what we expect to have the most tax policy, or at least potential for now in it? And look at what we have in our pocket with the infrastructure package, which I think if you look past some of the tax issues, the demand drivers for contractors, government contractors, construction, for real estate developers, pairing together things like the Opportunity Zone and desires and real pressure from investors, either institutional investors or shareholders, to embrace the concepts of ESG. And what are we doing around ESG? There's a lot in here in the energy efficiency space. And I would suggest everybody sort of focus on that and think about how you might take advantage of these demand drivers that are coming from the infrastructure bill. How am I going to take advantage of that? I see a lot coming in the terms of public-private partnerships, again, pairing incentives and some of the financing packages that are part of the bills that are being talked about. There's a lot of ways, whether that's looking at tax credits in the jurisdiction you're looking to invest or your business is in, things like payroll tax incentives, property taxes, other business incentives, all the way through this continuum of energy and efficiency. And consider, is this the opportunity to embrace this volatility? I'll say again, but to say, if I was a heavy highway contractor and I was looking to retool my technology, my processes, my plant, my property, my equipment, things of that nature, now's the time to really look at that. And how can I best put myself in a position to take advantage of some of these behavioral based incentives and credits out there that'll help my business in the long run, and still take advantage of things that we have at our fingertips today, which are accelerated depreciation and favorable cost recovery methods. And then also think of that in an environment where rising tax rates are likely going to be continually a threat, given how much money we've had to provide in terms of support and incentives through the pandemic. And I think we're a couple minutes over time. The last slide was that concept, is bringing it all together. And this visual is sort of purposely futuristic from the standpoint of, if you look at this picture and kind of take it apart, a lot of what's in here translates to the tax policy that we're looking at today to drive some of the agenda items that Rochelle mentioned earlier. So thank you, Ryan, for hosting, and thank you for the time with your clients. We enjoyed it.
Thanks for, excuse me, thanks for taking the time. I mean, this was an incredibly informative situation for me, I know, and hopefully for all those that participated and all those that will see this down the road as well. It just reinforces the fact that good partnership and well-informed partnership, not in the tax sense or the entity sense, but in the professional sense, is just hugely important for us. I mean, the tax planning that happens for everyday actions, as I said before, in the CRE space is just, it's huge. We're making loans based on tax. Tax is always informative around the transactions that we do. So having a better understanding of it is just, it's the thing to do. So I thank you both, Tim and Rochelle, for your insights and your depth of knowledge. It's just amazing. So thank you. And thanks to all the participants out there that joined us today. I think we have a Q&A. I don't know if there's any questions in the chat box. I don't see any. So I think we're about ready to wrap up.
Yeah, I mean, it's not uncommon with a broad approach and short amount of time to not have questions, because there's just so much of what we talked about. But either through Eagle or through us, we're happy to drill down on this and spend some time with anybody that has any questions or concerns. And the main thing is just be alert, keep your eyes open, and fire up the Excel and start seeing where you might take advantage of some of the things that are happening.
Stay flexible.
Exactly. Well said. Thank you.
All right. Thanks, everybody.
Thank you also to the Eagle team, marketing and otherwise, that helped with this production. I see Vicky's still on, maybe, and Kathy, and there's one other name that I'm not saying at the moment, but
I think Mercedes was involved too. But thank you just to everybody that put this together. It's been a great start to the Friday, and send us into a much awaited weekend. All right.
Thanks for everyone. Bye-bye.